Ethereum just pulled off something it hasn't managed in nearly 4 years, breaking out of the long downtrend that's kept it pinned since late 2021. If you hold ETH or are thinking about getting in, this is the kind of moment that can change your positioning for the rest of the cycle. Moves like this don't really happen that often, and the forces behind it aren't what most people expect. This breakout didn't happen overnight. It follows years of false starts, fading rallies, and a market that repeatedly struggled to find momentum. Now, with the trend finally reversing, there's a clear change in how both retail traders and institutional players are approaching Ethereum. My name is Danielo, and today we're breaking down exactly what's driving this move, why it matters, and the signals you should be watching if you want to stay ahead of the next big shifts in crypto. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Ethereum's chart has been a masterclass in frustration. For over 3 years, every attempt to push higher ended the exact same way. A promising rally, then a sharp reversal. In 2022, macro conditions were brutal, inflation spiking, the Fed hiking rates aggressively, and risk assets across the board selling off. ETH fell more than 80% from its highs, and each bounce got sold into faster than the last. The turning point started quietly. By mid-2024, inflation readings had stabilized, the Fed had slowed its tightening, and broader liquidity conditions began to improve. That removed a massive weight on crypto. At the same time, most retail traders had checked out entirely. Sentiment was so beaten down that even solid rallies failed to grab attention, and, ironically, that's the kind of environment where sustainable breakouts form. This breakout is different because it wasn't sparked by a retail euphoria or a fleeting narrative. It was driven by a large, steady accumulation over months. That's a telltale sign of structural demand, the kind of demand that can keep price supported through volatility. The question then becomes, who's doing all this buying? When you follow the money, the biggest shift is hard to miss. For the first time, Ethereum ETFs have been posting inflows that match, and in some cases exceed, Bitcoins. Billions of dollars have moved into these vehicles since launch, and unlike retail-led rallies, this capital isn't hot money looking for a quick flip. ETFs solve the compliance and custody hurdles that kept many institutional players on the sidelines in past cycles. Pension funds, family offices, and corporate treasurers can now buy Ethereum exposure without touching a crypto exchange. The result? A steady bid that soaks up supply and puts the floor under price action. And the ETF flows are just one piece. Public filings show companies like Sharplink Gaming, Bitmine Immersion Technologies, and Ether Machine allocating ETH to their balance sheets, a move almost unheard of before 2024. Fundamental Global went even further, filing a $5 billion mixed shelf offering that includes ETH exposure. These aren't swing trades, they're long horizon bets often measured in years. Institutional demand changes the character of a market. Instead of all this chaotic pump and dumps, you get accumulation phases where price grinds higher, absorbing sell pressure. It's a fundamentally different backdrop than the mania of 2021. And it means ETH's breakout isn't happening in a vacuum. It's happening in a market where the biggest buyers aren't going away anytime soon. Just 18 months ago, Ethereum was in the crosshairs of regulators. The SEC was making noise about staking potentially being a security. The CFTC was unclear in classification, and DeFi protocols were facing enforcement threats. The tone from Washington was openly hostile, and it weighed heavily on market confidence. Fast forward to now, and the shift is hard to overstate. The SEC's Project Crypto has moved from a crackdown posture to hosting roundtables with industry leaders. Instead of framing staking as a securities violation, recent guidance has clarified that Ethereum's staking model isn't being treated that way under current interpretations. That's a massive psychological and practical win for the network. And keep in mind, it doesn't actually stop there. A recent executive order under the Trump administration opened the door for 401k retirement plans to gain crypto exposure. That's potentially a 12 trillion pool of capital that, until now, was completely walled off from Ethereum. The move signals something bigger, not just regulatory tolerance, but active policy support for integrating crypto into the mainstream financial product sphere. This matters because regulatory tone dictates capital flow. For years, institutions had the desire, but not the green light. Now, both are aligning. Those shifts are already visible in on-chain metrics, numbers that tell us adoption is accelerating, even before ETH retests its all-time highs. For instance, total value locked, or TVL, across Ethereum-based protocols recently hit $306 billion, the highest in the network's history. That's not just idle capital sitting around. It's an indicator that more assets are being committed to DeFi applications, from lending protocols like Aave to liquid staking platforms like Lido. That kind of growth during a mid-cycle rally shows that users aren't just trading ETH, they're putting it to work. Stablecoin flows tell a similar story. The supply of major stablecoins like USDE and USDS have expanded rapidly, while Circle and Tether continue to see net growth in circulation. Stablecoin activity matters because it's the grease for Ethereum's on-chain economy. Every DEX swap, every lending transaction, every NFT purchase runs more efficiently when stablecoin liquidity is deep. Then there's the ETH-Bitcoin ratio, which has quietly started rebounding from historic lows. Now, that might sound like a trader's chart, but it's actually an adoption signal in disguise. When ETH gains strength relative to Bitcoin, it's often because more capital is flowing into Ethereum's ecosystem for practical use cases, not just a store of value. Put all these elements together, and you have a network that's already breaking adoption records before the price catches up. And that ETH-Bitcoin ratio in particular gives us an important clue about what could come next, without making any wild predictions. If you've watched previous crypto cycles, a familiar pattern tends to emerge. Bitcoin makes the first big move, grabbing headlines and pulling in all the new capital. Ethereum follows later, sometimes months later, but when it starts to run, the gains can outpace Bitcoin's by a wide margin. This lag isn't random. Bitcoin is still seen as the safer, more conservative play by both retail and institutional investors. It's the first stop for capital entering the space. Ethereum, by contrast, benefits once that capital starts looking for higher upside and more utility-driven exposure. The ETH-BTC ratio is one of the simplest ways to track this shift. Historically, when the ratio bottoms and begins to climb, it signals that investors are rotating out of Bitcoin into Ethereum and related assets. We've seen this in past cycles. A slow grind higher in the ratio often precedes sharp ETH rallies that leaves Bitcoin's percentage gains in the dust. Right now, that ratio is showing signs of life after a long downtrend. If the trend continues, it could mark the early stages of Ethereum's catch-up phase. And ETH's momentum doesn't just affect Bitcoin, it has a ripple effect across the entire altcoin market. The key is knowing when that rotation starts, and there's one chart that gives us a surprisingly clear signal. One of the cleanest indicators for this is Bitcoin dominance, the percentage of total crypto market cap held by BTC. When dominance is high, capital is concentrated in Bitcoin, but when it starts to fall, it usually means investors are rotating into other assets. Over multiple cycles, a specific level has stood out, roughly 60.5% dominance. Historically, a weekly close below that level has often lined up with the start of sustained altcoin rallies. It doesn't guarantee an immediate explosion, but it's a sign that market participants are willing to take on more risk. Right now, Bitcoin dominance is hovering just around that line. If ETH continues to lead and push sentiment across the market higher, a confirmed break below 60.5% could set the stage for a broader altcoin move, one that lasts weeks or months instead of just days. And if that happens, this cycle could play out very different from the last, which brings us to an important question. Are we still in the same 4-year rhythm, or are we entering something entirely new? For more than a decade, crypto has been driven by a familiar 4-year cycle, a boom after Bitcoin's halving, followed by a bust, then a long recovery before the next rally. It's a simple rhythm that traders have come to expect, but the forces driving Ethereum right now suggest we might be breaking out of that script. Institutional capital isn't moving on the same timeline as retail hype. It doesn't care about halving dates. It responds to liquidity conditions, regulatory clarity, and product market fit. And all three of those have been aligning in Ethereum's favor. Regulatory tone has shifted from suspicion to support. ATHs have opened the door to new types of buyers who weren't even in the market during the last cycle. On-chain adoption metrics are hitting record highs before the price has even caught up. And perhaps most importantly, Ethereum isn't just a speculative play anymore. It's infrastructure that powers stablecoins, decentralized finance, and tokenized real-world assets. That combination could stretch this market beyond the sharp peaks and deep troughs of the past. Instead of a single euphoric run followed by a crash, we could see extended periods of steady inflows and sector-specific rallies. For investors, that means the playbook from 2021 might not work the same way in 2025. If this is the start of a new kind of cycle, the real opportunity isn't just in chasing the next parabolic move, it's understanding which signals actually matter as the market matures. Ethereum's breakout isn't just another chart pattern playing out. It's the result of 4 years of structural changes finally converging, record ETF inflows, a regulatory shift from resistance to support, and on-chain metrics hitting all-time highs before prices even followed. These aren't the kind of catalysts that disappear overnight. Keep in mind, institutions don't move in and out on a whim, and policy changes don't reverse because of a bad week in the market. The adoption we're seeing, from stablecoins powering everyday payments to tokenized assets bridging into traditional finance, is creating a foundation that's built to last. That's why the most important move right now isn't chasing every green candle, but watching the signals that show this momentum is real and sustainable. The question is, when the next leg higher begins, will you be ready based on the signals we've covered today, or will you be scrambling to catch up? Let me know down in the comments. If you found this video valuable, hit subscribe, tap the bell, and share it with someone still on the sidelines. Thanks for watching, and I'll see you in the next one.